Hello everyone. Today in this session, we are meeting to solve a Section C requirement, a Section C past paper question. This is the most recent one which is available. We are now preparing for the September 25 exam. So this is the most recent one, March, June 25, which we are solving together. Now the name of the question is Grow Company. And as you can see from the very first requirement itself, this pertains from the working capital area of the syllabus. Now, usually, this is not the usual kind of question that gets tested. Usually, you get tested on the inventory management or your receivables and payables management. But here, you have to answer a slightly different requirement. Now, this is not something which you have not studied as a part of the syllabus, but it is something which you don't often see. So, if this happens to come straight away in your exam and you have not seen many questions like this, you might get surprised that what kind of a question is this? So it's good that we are getting to practice this over here so that just in case something on similar lines, if not the same thing comes up in your exam, then you will be able to answer it in a good way. So let us get started. Whenever we are solving a 20 marker requirement, the first thing that we do is not jump right into the case study. We first have a look at the requirements. So we will have a look at what all is being asked from us here. On the right hand side of the screen, I can see that for 12 marks, I am supposed to answer this thing using suitable working capital ratios and analysis of the financial information provided. I have to evaluate whether grow company can be described as overtrading. And they have given me a note that maximum 6 marks can be obtained with calculations. If you want to get the remaining 6 marks out of the 12, you have to do an analysis, you have to do the interpretation of the ratios that you calculate. So we are not going to spend a lot of time trying to give as many ratios as possible because I know at the end of the day, no matter 100 ratios I calculate, marks are only 6. So I'm going to split my time accordingly. I will take half of the time in calculations and half of the time in the analysis. So for this, before we even read the question, we'll just have to quickly revise what is the concept of overtrading. So Ishika, do you remember how do we define overtrading or when do we say a company is overtrading? No? Okay, so overtrading basically is another word that we have is undercapitalization. What do we mean over here is I am trying to expand my business in a very huge proportion, but I do not have the funds to sustain that level of business. So if let's suppose the total amount of money which I have with me is maybe 1 crore, and I'm trying to do a business where my customers and my suppliers, I am dealing with hundreds of crores. So I do not have the money myself to sustain such a high level of business. So this is what happens in overtrading. Businesses want to expand rapidly without thinking, do they even have the capacity? Do they even have the working capital to manage those things in the longer term? So this is what we are supposed to evaluate. Are they doing overtrading? Now, when you people would have learned the concepts, you would have when we were learning this concept of overtrading, you would have come across one topic that's there in the study hub where they teach you that what are some signs of overtrading, what all things will you see in a company, like how doctors judge your symptoms. If you're having if you're sneezing all day, if your nose is running, the doctor gets to know that it is a viral fever. So this is how these are a few symptoms which companies are facing, because of which we are able to diagnose that the problem is overtrading. So what are those symptoms? The revenues will rise rapidly. Inventory is going to rise rapidly. Your receivables are going to rise rapidly because just because you want to do more and more sales, you're not thinking twice before offering credit to your customers. Blindly, you're offering more and more credits to your customers. As a result, you are, because your customers are taking too long to pay. So now you have to, source money from other sources of finance to actually give the money back to your suppliers. So this is what happens in overtrading. Now let's have a look at the scenario. The scenario tells the following financial information relates to grow company. The statement of profit or loss gives us the extract is basically given to us. And then the statement of financial position extract is given. And all sales are made on credit. That means we are allowing credit to each and every one. We do not do any cash sales. And we are operating for 365 days every year. So that is what I'm supposed to take as the number of days in each year. So now I'm getting started with my working. Part A wants me to calculate some suitable working capital ratios. So in working capital ratios, we have learned inventory holding days, we have learned receivables collection days, we've learned payables collection days, and the total of that gives us the cash operating cycle. We add inventory and receivables and we subtract the payables. So that is something that we do when we are calculating the cash operating cycle. So these are a few things which we can show the calculations of. So what I will do is I will quickly create a format over here. There are 2 years which we are talking about, 20x6 and then 20x7. So what all ratios I'm going to be calculating? I can calculate the inventory days, inventory holding days. I can also do a calculation of my receivables collection days. I can do a calculation of my payables payment period, payables payment period. And then I'm going to also calculate the cash operating cycle. Ishika, you haven't missed much. I was just explaining the concept briefly of overtrading, and then I went through the reading of the scenario. So you haven't missed much. Okay. So now we will calculate these ratios one by one. Inventory holding days, we've already learned the formula. The formula that has been taught to us is that you take your inventory, you divide that by the reason why you have that inventory. So the reason why you have that inventory is because you incurred money on making that inventory, which is your cost of sales. So your inventory holding days are going to be the value of your inventory, which is 59 and 20x6. And then you're going to divide this by the cost of goods sold that you have, which is 720, and this has to be multiplied then by 365. So this is how you get the inventory holding days. Similarly, you can do it for the next year also. 20x7, the value is 107 for inventory, divided by the cost of goods sold is 1300. So this should not take very much time on your end because these are formulae which you have been learning since a very long while. What you can also do is reduce the decimal places and make it only one figure. Yeah, so this is how you can show in terms of absolute total days. Please do not annotate on the screen. Okay, now talking about the receivables collection, again, we have learned the formula that you take your receivables, which is 111, you divide that by the reason why you have those receivables. Reason is you sell people things on credit. So I have sold 900 worth of revenue. So, and then this has to be multiplied by 365. So this is what my receivable collection days is going to look like. Same, I will put in the numbers here also. Receivables, I have 252 divided by revenue is 1530 multiplied by 365. So this gives me the receivables days. Same, I will do the payables days. Payables that are given to me are 63. The reason why I have payables is because I did not pay my cost of goods on time. So the cost of goods is 720 for the first year. So divided by 720 into 365. And then for the other one also, the payables are 143. And then the cost of sales is 1300 multiplied by 365. So here I have my numbers ready with me. That these are the number of days that I am doing for inventory, receivables, as well as payables. Now I can find out my cash operating cycle. The formula that I've learned is you have to add inventory and receivable days and subtract the payables payment period. So this is what your inventory, the cash operating cycle is basically going to look like. So if you see the early signs of overtrading are clearly visible from the cash operating cycle itself. Because I'm trying to rapidly expand my business, I'm giving more and more period of credit to my customers. Earlier, I used to collect debt within 45 days. Now it is taking me 60 days to collect that same money. And here, payables also, I am delaying the payments because my cash position is not very nice. My liquidity is suffering as a result. This is what is happening. Another thing which we can calculate over here are the current ratios as well as the quick ratios. So we know the formula for that also. We have to take the total of the current assets, divide that by the total of current liabilities. So the total of current assets in 20x6 is given to me as 214. And this needs to be divided by the total of current liabilities, which is 63. And then for the other year, it is 359, and then this has to be divided by 154 worth of current liabilities. So this is what my current ratios are going to look like. Here I can possibly give answers to two decimal places. So this is what these ratios are looking like. Same, I can also calculate my quick ratio. How do we calculate the quick ratio? We take all current assets except for inventory. So all of the current assets were 214. From this, I will take away the inventory, which was worth 59, and I will now divide this number by my current liabilities, which are 63. Similarly, I will do around this. I have with me is 359. From this, I want to exclude the inventory worth 107, and I divide this by my current liabilities, which were 154. So here also, I have gotten my quick ratios worked around for both of the years. Lost my network, but are you able to hear me? Was I missing in any part? I think I lost my network in the middle. Were you able to hear me? Okay, great, great. So with the current ratio and the quick ratio also, I can see that these ratios are deteriorating. They are getting lesser. Our liquidity is on the decline. A few other ratios, what else can we calculate so that our analysis can become better? We can calculate the increases in our sales, inventory, receivables, as well as payables. So let's calculate that also. Increase in sales, increase in inventory. What I can do is I can copy increase in, and then I can keep pasting that everywhere. Increase in number one, my inventory. Then I can talk about increase in receivables. A lot of the copy pasting functionalities are yet to work in the new practice platform. I hope that ACCA resolves this quickly. A lot of students do keep complaining about the new practice platform and how they're not liking it very much. Okay. And then we can also talk about increase in our net working capital. Increase in net working capital. Okay. So how do we calculate basically the increases? Increases are the new figure minus the old figure divided by the old figure. So increase in sales. This year I have sold 1530 minus previous year was 900. Divide this by the previous year figure. So your sales have actually risen by these many percentages. Same you can find out for inventory. Inventory earlier was 59, now it is 107. 107 minus 59 divided by 59 was the original number. So this is the increase in your inventory. Same you can do with receivables. 252 minus 111 divided by 111. And then, okay, have we done this correctly? All right. Then the next thing that you have to do is about the payables. Payables are 143 minus 63 divided by 63. So this is the increase in our payables. If I talk about my net working capital is basically how much in total did I have earlier? My apologies. Earlier, my working capital used to be the total of my current assets was 214 minus the total of my current liabilities was 63. Now I have a working capital of 359 is the total of my current assets. If I take away my current liabilities 154, this is what my working capital looks like right now. So if I want to find out the increase in my working capital, net working capital, I will see the new value minus the old value divided by the old value. So this is the increase in my net working capital. Now, talking about how much have my operating margins looked like. So if I talk about my operating margin, I will see how much money have I earned over my revenue. So I have earned a total of PBIT of 230 on a revenue of 1530. Then in the next year, I have earned 180 over a revenue of 900. Sorry, I've flipped the figures. This is for 20x6 and 20x7. Wait a second. 20x7, I have taken yes, and 20x6, the numbers are PBIT was 180, and I divide this by my revenue of 900. So I can see that my operating margin is also on the decline, which is another bad thing which will happen to the business. Now, I think we are in a decent position to start writing our analysis. I think we've done enough calculations to be able to secure the 6 marks that are available for the same. So now let us come to writing about the analysis. So how do we find out? How do we leave a comment about if the company is doing overtrading or not? So firstly, what we are going to do is we're going to talk about what exactly is overtrading. So overtrading is that scenario. Overtrading happens when a business tries to expand rapidly without considering the capital needed, or you can say the working capital needed in the long term to sustain that scale of the business. So this is what you start off with. Just a brief definition of telling about what overtrading really is. Then you will start to do your analysis. How you're going to do your analysis? 6 marks are available for this analysis. So it's better that we use subheadings and then we do our analysis. So the first subheading which we can potentially use over here is about how have my assets and liabilities changed. So I can say what has been the change in assets and liabilities of the business. So if I talk about the assets and liabilities of the business, there are two things. Firstly, I saw my net working capital increasing. Net working capital, we have seen it has increased from 151 to 205. So this is what the increase in the working capital is looking like. So we will comment that there has been a significant increase in the amount of working capital. Now, if I talk about the other aspect, working capital includes current assets as well as current liabilities. What else is there? Assets. What are the other assets available? Non-current assets. So we can see that non-current assets have risen by, earlier they were 450, now they are 500. So we can say non-current assets have risen by 50 million, and possibly this was done to find buy the new assets for the expansion. So this was possibly for the expansion of the company. Then what do we see in terms of liabilities and equity? Let's have a look at that also. We can see that the ordinary shares have remained the same. And then when it comes to the non-current liabilities, they are also the same. That means no money, no additional money has been raised from equity or debt to expand the scale of the business. All right. What else can we talk about? This was the first subheading, that what is the change in the assets and liabilities. The second subheading that we can talk about is the capital. So how has the capital of the company actually changed? So when you see the equity segment of the balance sheet, there's been an increase in the reserves. Earlier, we had reserves of 161 million. Now we have reserves worth 265 million. So we can say that long term, we can see the long term sources of finance, we can see retained earnings have increased. And then I think the additional money, this point is going to make much more sense here under the capital aspect. So this is what we can bring to here. Now, talking about another subheader which we can put here is about the liquidity. We can comment about the liquidity of the business because we've calculated the current and the quick ratio. We can see that both of these numbers have actually declined. Does it give us any further information to draw a comparison? Not really. So we just have to compare with the previous year, how earlier our current ratio as well as quick ratio was a higher number, but both the ratios are now declining. The current and the quick ratios have both declined compared to the previous year, further indicating that the business is facing liquidity strains, that they are not being able to meet their payments on time. What else can we talk about? We saw that the operating ratio, the cash operating cycle was actually increasing. So here we can talk about the cash operating cycle also. One subheader can be that cash operating cycle. The cycle of the business has increased in terms of days, that means that the business is taking more time to convert investments into cash. Simple meaning is that whatever I'm investing, cash actually returns back after a very long time to me. So whatever I invest, I have to keep that invested for a very long period of time so that I'm able to get that money back. Another thing which we can add in the change in assets and liabilities point is our inventory is significantly on the rise. We saw how there's been an increase in inventory by 81%. This is a huge increase. Our inventory has increased by 81%. This is also an indicator of overtrading. Another thing that we are doing with respect to our receivables have actually increased by a whopping 100 something percent, 127%. So you will say over here that the receivables have more than doubled. That means to boost our sales rapidly, we are allowing credit to more and more people. So this is also something which is a sign, which is an indicator of overtrading. Same thing we observe with our payables also. Our payable payment period has also gone up, and there has been a significant increase. If you talk about a percentage, it is 127%. Here also your payables have more than doubled. That means you are taking more and more time to pay your suppliers, which is also a bad thing for the reputation of the business. You can add that point also here under the change in assets and liabilities, that payables also we are taking longer to pay, indicating liquidity issues, that the business definitely has something fishy going on. What else can we possibly talk about? Some other factors that we can say, other factors. I can tell that the operating margin also we had calculated. Earlier, it used to be 20%, now it is down to 15%. So we can say that the operating margin of the business is also on the decline. We are offering more credit to our customers and taking longer to pay our suppliers. So this is something that you can add here. Now, whenever you have 12 marks of a question, it's very good if you people write a conclusion over here. What conclusion can we give? Possibly, the conclusion can be that the company has started to show signs of overtrading. Currently, if you talk about the company, their ratios, if you talk about the liquidity ratios, the ratios are still above the recommended averages. What are the recommended averages? For current ratio, the ideal ratio is 2 is to 1. Quick ratio, it is 1 is to 1. But so that means the company is definitely not facing going concern issues at the moment. At the moment, we are still solvent. However, if we continue to expand so fast like we have been doing without raising any money from long-term sources like equity or debt, then it is possible that the company will fail. So we can give a conclusion also over here. The conclusion is going to be that the company has started to show signs of overtrading, has started to show signs of overtrading. However, the liquidity ratios are still above the recommended ratios, and hence the company is still solvent. If the company continues to proceed this way, continues to expand rapidly without raising long-term finance, then the business has chances of failure. So this is how we are going to conclude this 12 marks of requirement. With this, part A has now been solved. Let me know if you have any queries. Otherwise, we will proceed to the second requirement that's there. All good till here? Yes, any doubts? Uh, Ma'am, is it good to highlight the important keywords while writing the theory in exam? Definitely, yes. It's a good practice if you do that because this makes it very easy for the examiner to evaluate your copies to find out what exactly you're talking about. Like here, I have used subheaders and I've made those in bold. That means whenever my examiner will have a look at this, they are going to understand that these are the points that I'm talking about in broader sense over here in this small paragraph. So yeah, definitely it helps. Okay, now proceeding to the part B of this question, we are supposed to explain the advantages and disadvantages of a conservative approach as compared to an aggressive approach to the financing of grow companies' working capital requirements. Now, this is a requirement worth 8 marks. So we are supposed to talk about the benefits as well as the problems associated with both of the methods that are there with us, aggressive as well as the conservative method. And we are going to compare the both of them, that if I am choosing one over the other, what is the benefit am I getting and what is the problem that I face because of not choosing the other method. So what we are going to do over here is we will talk about the methods one by one. The working capital requirements can be funded using multiple possible approaches. Two of the approaches are conservative and aggressive approaches. So you can now use subheaders and first talk about any one of the approach. So let's suppose we're talking about the conservative approach first. Conservative approach. So, as the name itself suggests, this approach is conservative. We take lesser risk. You people, let me know when it comes to financing my working capital requirements, there are two sorts of current assets. What are those two sorts of current assets? What are the two types of current assets that we have? You people would have just revised the working capital areas of the syllabus. What are the two types of current assets that we have? The two types of current assets that we know of are permanent as well as fluctuating current assets. So permanent assets are those, even though they are current assets, but they are those assets which remain with us for a longer time frame than the other assets. So for example, there is some buffer inventory that I'm holding. So the buffer inventory, let's suppose the total inventory that I have is 1000 units. 200 units I always keep as a buffer, that no matter what happens, even if a customer comes overnight, I should have 200 units at any given point in time so that I never lose out on any sale. And then there are those 800 units which I keep selling in the market and I keep buying more, keep selling. So those 800 pieces of inventory, they are the ones which I'm trading on a very regular basis. So if I'm trading them on a very regular basis, they become my fluctuating current assets. But the other ones which I keep with myself for a very long period of time, like buffer stock, like any precautionary cash that I'm holding with myself, so those assets are considered as the permanent current assets because they stay with me for a longer duration of time. So because we have two different categories of these assets, one approach will use more of one type of asset depending upon what is the approach there. So if it is a conservative approach, conservative we call someone who does not like to take a lot of risk. So this approach is going to have more of long-term assets, long-term sources of finance will be used to finance the permanent assets, permanent current assets, as well as a portion of fluctuating current assets. Even though I know that the fluctuating assets I don't need for a long term period, but still I will finance my fluctuating assets also with the long term sources because here I want to be as safe as possible. How do long term sources give me a safety? They give me a safety because the maturity is in the long term. I can keep using the finance as long as I want, and I only have to repay that money back when the duration of the loan has ended. So when the loan has matured, only then I have to make the payment. So there's no risk over there. I always have the money until the redemption or the repayment date. So here, what do I do is just to be safe, I finance more of long-term sources of finance to get my money for the permanent assets also, and then the portion of the fluctuating current assets also. So what will be the benefit with respect to this method? The core benefit will be that it is less risky, it is more safe, it gives me more safety. How? Because there is no possibility of having to repay that money in a short duration of time. The money can be used by the business, till the maturity or repayment date for whatever reasons that they want to. And what will be the drawback? Not any approach will come only with the benefits. There will be drawbacks also. Absolutely correct, Tushita. The drawback with this approach is that it is going to have a high cost. It costs you high because long-term sources of finance always carry higher interest, higher interest compared to short-term sources. So this is the drawback that we get. If we are choosing the conservative approach over the aggressive approach, this is the problem that we are going to face. Now let's talk about the other approach, which is the aggressive approach. So aggressive approach, the definition that we have learned is that you are using more of short-term resources, short-term sources of finance will be used to finance the fluctuating current assets as well as a portion of permanent current assets also. So here, what will be the benefit and what will be the drawback? Exactly the opposite. Now here, when we were being conservative, we were more safer. We were more, we were lesser on the riskier side. But here, with the aggressive approach, that exact thing becomes the drawback. What is the drawback? Usually, you can also add in examples. So what will be the examples that we are using in the conservative approach? If we are using more of long-term sources, we will use long-term loans, we will use bonds, we will use share capital. So this is how we are going to finance the thing. And then when it comes to your aggressive approach, what are a few examples of funds that we are going to use? Examples will be overdraft. Examples will be payables. So here, the biggest drawback that you have is it is more risky. Now, when it is more risky, what happens is when you are using overdraft, when you're using payables, you have to make the repayment when the bank demands you if it's the overdraft. And if it is your payables, your suppliers can actually put pressure on you that it is high time you make our payment right now. So the drawback with the aggressive approach is definitely that it is more risky. The repayment has to be done as per the demand in terms of overdraft. So here there is a risk that if I need the money again, if Gru company needs rollover. Rollover means I want the same loan. Let's suppose I took a loan for 3 months. If I want to have it again for 3 months, there's a risk that the bank will reject that request of mine. So if Gru company needs rollover, there's a possibility of rejection. So I might not get that money again. My business was going fine because I had that money. Now, because I have to return it, I may not be able to sustain. My business will face liquidity issues. So this is the drawback with this method. And whatever was the drawback with the conservative approach, that exact thing will be the benefit with the aggressive approach. The benefit in this case will be that it is going to cost you low because the short-term sources of finance are more cheaper. Short-term sources of finance are cheaper. Here we are using more of short-term sources of finance, so we will be able to save on our costs. So the benefit is that it will be cheaper for the business, but the drawback is that it will be more risky for the business. So this is how we will frame our answer for this 8 marks of requirement. And with this, we are done with the practice of Gru company. This was a 20-marker question pertaining to the working capital area of your syllabus. So I hope that when you people tried it on your own and then you came to this, you people were able to gather more insight as to how you will draft your answers. So let me know if you have any queries. Otherwise, this is where we will stop for today. Any queries? Okay. All right then. So this is it for this video. I will see you the next time. Your tests are going to go live as per the schedule. So ensure we have a long weekend coming up. So a lot of you may be, getting busy in the celebrations and everything. But always remember the exams are also equally important. So keep your progress on track. I'm not saying you to not enjoy the things, but enjoy everything. But at the same time, keep your study on track because the exams are not very far away now. So I wish you all the very best for your exams. Do let me know in case if you have any difficulties.